Bank of America is facing its most apocalyptic phenomenon since the Great Depression. The bank crisis that is spreading worldwide is only another chapter in the unfolding of the economic collapse. In today's video, we're going to examine the recent statements of the bank's currency strategist Athanasios Vamvakidis to help you recognize where we've been up until now and grasp what the 9th cycle of the financial fiasco looks like. Firstly, he reminds us that the health crisis-related infections are still rising in Europe in recent weeks, since it has reached a new reopening peak last week. Vamvakidis admits to being concerned that reopening will lead to higher infections in Europe and everywhere else. The trade-offs between going back to normal and containing the spread of the disease are now clear. Before moving on, we have been noticing that you guys are missing the gloomy voice. For those of you who don't know what goes on behind the scenes of content creation, hiring a world-class narrator costs thousands of dollars every month. We would appreciate it very much if you could support Epic Economist on Patreon. With only a small monthly membership, you would assist us in the payment of our staff, and we would be able to keep delivering you quality content every day. To make one video, we have to manage our script writers, video editors, and our legendary narrator. We take more than 15 hours to present you exclusive and out-of-the-box information. By signing up on Patreon, you would also help to give millions of people a realistic perspective of the economic collapse and help them to prepare for the next Great Depression. For those of you who already helped us, thank you very much. But if you haven't already, please be a part of our mission and sign up on Patreon to support our channel. Carrying on, in a second note, the strategist reminds us that there was a considerable decline on the Eurozone August PMIs, which confirmed the perspective that the initial rebound was simply from base effects after the lockdown, and that the cleaner data from now on will reflect a weaker recovery and output well below pre-crisis levels. He reveals that the US data has also started weakening, with their economists expecting further slowing this fall. The third red flag is the feeling of disappointment in the market regarding the FOMC minutes last week, because they weren't dovish enough. The minutes had told that Fed policies would be outlook-dependent, but the consensus was expecting a strong, unconditional dovish message. In fact, the expert maintains that markets are pricing both loose monetary policies and a strong recovery, which he believes not to be realistic in any of the cases. Meanwhile, the US equities were back to an all-time high last week, with equities in the rest of the world also recovering strongly, he said. But that was before these 3 red flags caused a pause in risk assets. On the other hand, there is no fiscal deal yet in the US, and some benefits are already expiring. The end result he can see so far is that the real economy remains weak and fragile while macro policy support has its limits, but markets are optimistic on both fronts. Of course, this optimism is directly linked to MMT. In this context, Vamvakidis questions that even if the real economy is weak and the recovery from the sanitary outbreak doesn't look like a V or a U, what would prevent fiscal and monetary policies from maintaining support of risk assets? In any case, the real output is well below pre-crisis levels at this point, and forecasts are suggesting it will remain the same into next year, or even the year after. In turn, global equities seem to be almost completely recovered. Yet now the real risk is deflation and not inflation. For this reason, nothing prevents more fiscal policy stimulus funded by more money printing. And naturally, central banks would keep policy rates low for as long as necessary to help governments deal with the massive debts they are accumulating. That's exactly what markets are pricing, according to his view. Furthermore, he poses many thought-provoking questions, starting with, why stop there? Is supporting the economy after a shock from a global outbreak more urgent than addressing rising income inequality or climate change, just to mention 2 of many other possible examples? highlighting that if we are already implementing modern monetary theory, what's the budget constraint? That is to say, stocks at all-time high doesn't necessarily indicate the situation is sustainable. In accordance with the specialist's outlook, things could have been different if the sanitary outbreak had happened in a moment where the global economy had lower debt and higher interest rates. Quite the opposite, most countries didn't seize the opportunities of the good times in the years before to create enough policy space because they didn't see these years as good enough. Since the late 1990s, macro policies have been loose in good times and even looser in bad times, he reiterates, while explaining that many countries have been converging towards MMT without even realizing that they do. In his view, extraordinary macro policy support is absolutely necessary in response to a global health outbreak that takes place once in a century. However, the problem is that policies were loose and debt high even before it started, meaning that the disease spreading only accelerated the banking collapse and the economic downfall. In short, without inflation, there is no budget constraint on the basis of MMT's policies and in the current state of affairs worldwide. Thereby, as long as the pandemic lasts, fiscal and monetary policies can offer as much support as necessary and a lot more. Even taking a look ahead in a post-sanitary outbreak world, there won't be any rush to tighten these policies, allegedly to avoid jeopardizing the recovery, as was also the case in the years following the global financial crisis. After all, Japan has been in this reality for the last 30 years. Normally, loose macro policies in a good or a bad state of the global economy at some point will lead to inflation. And, of course, the longer it takes, the more addicted markets become to macro policy support, making the eventual adjustment harder. Even if central banks are willing to overshoot their inflation target, non-linearities may make their task challenging, while in any case, markets may start pricing rate hikes, and the so-called central bank policy could weaken. Only low inflation has allowed what he calls the "I'm so bearish, I'm bullish" market in recent years. This is why the Fed will do anything it can to keep inflation from becoming a budget constraint. Consequently, when inflation arrives, this balance will be broken. The evident obstacle, as he defines, is that inflation has been the dog that has not barked in recent decades. Considering everything that is going on with the world today, this seems to be one of the least important concerns since the outbreak is well below potential and a very weak recovery is foreseen. What's more, markets are also pricing low inflation and low interest rates for the predictable future. By contrast, debt will probably remain high in most countries in a low-inflation situation. The only way out would be to reduce debt to pre-outbreak levels and subsequently to pre-global financial crisis levels, which should require massive fiscal austerity and private sector deleveraging. However, he mentions that as long as inflation remains low and central banks keep policy rates at zero, there is no reason for such pain. Nevertheless, this is still a scenario of cyclical bubbles. While the real economy is barely afloat, asset prices will keep their strength because the loose macro policy supports even more the decoupling between Wall Street and Main Street. Things are likely to continue the same until an unexpected shock takes place on the markets, making asset price bubbles burst, thereby needing even looser macro policies to avoid an even weaker real economy, which will create new asset price bubbles. As a result, we have a vicious loop spiraling to an infinity of increasingly higher debt levels, lower interest rates, and larger central bank balance sheets without inflation, but with an even weaker real economy and even worse asset price bubbles thanks to the Fed's policies, which will boost this unprecedented economic crash to a whole new level. This downward spiral had probably started with low inflation in the 1990s due to the development of structural forces such as globalization and IT, and, as Vamvakidis outlines, the widespread adoption of inflation targeting in the years that followed. Macro policies took advantage of low inflation to loosen too much, and one thing led to another, with a crisis every few years also keeping inflation low. In the final section of his statement, the analyst starts affirming that the endgame is not clear, but unlikely to be smooth. That says a lot about what we are still going to face in the future. This banking crash will be kicked off despite the fact that most central banks and governments are aware of these risks, or as the 1% may call them, opportunities. But they are stuck. Many attempts to tighten in the past ended up leading to sharp market adjustments, even when done in small steps. For instance, B of A mentions the Fed's QE taper tantrum and its sharp U-turn last year, cutting rates and expanding its balance sheet despite unemployment being well below the natural rate, to the ECB being stuck with negative rates well after the crisis, and despite serious side effects and reintroducing QE last year at effectively full employment. For its part, the government debt is already skyrocketing in most backdrops, especially after the health crisis had begun. The goal now would be to reduce the amount of debt with fiscal consolidation in the years ahead, without hurting the already weak economy, which is definitely a very challenging assignment, given all the aspects we've discussed up to now. In conclusion, Athanasios asserts that the B of A wouldn't start from here, claiming that there's no easy way out, because, in spite of the market euphoria up until now, the world economy is not in a good place, and it's getting worse with every shock. The situation did not look good before, and since the sanitary crisis began, it has become way worse, and this is not a sustainable situation for the long term. This is essentially the sketch of the whole current trajectory that led us to where we are now. With all that said, what are your thoughts? What do you think is going to be the spark for the ultimate economic downfall? Please feel free to share your opinions in the comments section down below. And don't forget to like and subscribe to help our community grow.